Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is Market Outlook for the week of March 25th, 2012. So if you like this, please be sure to sign up so you get it regularly on our website at MarketGauge.com, or you can visit us on our YouTube site and get the videos. So this week, choppy week, really made no progress whatsoever. In fact, for most of the indices, as you can see, we had a down week, down 1.1% for the week. We're still up over 1% for the month. In the Russells, down about 0.5%. The S&P also down about 0.5%. And the only thing that continued its gains is the NASDAQ. And by the way, just to point out here, this is a resource on our site. It's got a lot of great content, and that is the Little Big View. Little Big View includes this market overview. It includes the market hotspots page, which is a page, and this is a 20-minute delayed, but it gives you all of the leading groups for the day, the lagging groups, and the best performing and worst performing stocks. So I just want to point that out because a lot of people don't know that there is this free resource on the site. So let's go to the market. We're going to again focus on, of course, the macro picture because we saw a shift last week, and let's see if that shift persisted. Well, the first thing is, of course, this slightly down week in the S&P, just working off this weekly overbought reading in the relative strength. We've been, pretty much there for the last month or so, and this is the first week that we've actually got a little bit of a sell-off, so there's potentially a little bit more to come, but actually the response relative to how we've been moving up has been relatively modest, which we take as a good sign. So more sideways action. The amount that the S&P was down, very, very marginal, 0.5%, not much to talk about on the downside. And let's take a look at the longer term trends. Again, on a monthly basis, not quite at the extreme overbought, but getting close. Over that 97% level on the monthly basis would indicate getting rich on a very long-term basis. Remember, this is this green line here is the key 80-month moving average, and we use that as a benchmark to gauge the overall trend. And as you can see, we've been trading above it for the last 1, 2, 3, 4, 5, 6 months, and the actual trend is still accelerating to the upside. Now, also to note, this week was the lowest. This month so far, very, very low week, very low volume. And as you can see, the trend throughout this move up has been on decreasing volume. Now, a lot of people point that out. You can see that obviously major institutions are not fully invested. This is an interesting phenomena. If, in fact, the institutions come alive here, you could power a much, much bigger rally. Now, the opposing case could be that if we break this trend line, that the correction is going to be severe because there's not much underpinning this overall move up in terms of volume. So we just covered the weekly chart. We just covered the monthly chart. Looking at the daily, interesting pattern. You can see we got overbought here after that huge 200-point up move in the Dow. And then since then, it's sort of digested and then traded under the 10-day moving average. But can't really argue the market phase. Here's the 200. Here's the 50. This is the very fast moving average that we use. Traded under it. Doji day on Thursday means indecisive. tried to take it out, put pressure on the market, rejected the price. Market closed with on the top. So overall, slight pause here, but relatively modest. So what we have to see here is, can we get above that 10-day moving average? If we do, we have a very, very dynamic pattern, because basically you've got this, what I would consider a compression range. Let's take a look at that using a drawing tool. And basically the way I'm looking at this is that this here, and let's drop a parallel to here. This is your trading range. If we can break out on the upside of this accelerated trend line over here, we can certainly power out and could test the new highs and make new highs. So a breakout above this 2-day pattern and that gap down would take out that 10-day moving average, as well as leave this over here as a support level. So we're looking at this compression range here, not as tight and wide as some others, but still this is a valid compression range. And if we can breach that 10-day moving average out again and potentially off to new highs. So trend still intact, just a bit of a pause. Now let's take a look at some of the market indicators. Interesting, because the McClellan oscillator, you can see we got a buy signal back down here. We hit under our green line here, and that's the oversold area. Immediately pulled out the next day. So you had what we consider an intermediate term buy signal on the McClellan oscillator, confirmed by price action, right? And we got this nice up move. Now, interesting, we ended up working our way sideways and have generated yet another buy. So that's sort of interesting. With the sell-off to Thursday, after a couple of down days, actually brought us to the oversold region, and now with Friday's action peaked above it. However, on a shorter term basis, you're getting a sell signal, which was generated on the close on Wednesday, or near the close. And of course, we got the sell-off, but still got some more room to the downside. So interesting. The intermediate term trend looking positive. The shorter term indicators indicating that the sell-off should continue, maybe a pause. So pretty mixed. Overall, we have to go with the big picture, go to the higher time frames if there's a tie, and I would say that the overall trend still intact, modest sell-off. Also, let's go to the VIX. The VIX, as we had mentioned, that we had been in a warning. So we weren't particularly surprised to see the pause in the market and a couple of days of down action, but nothing really has materialized in terms of a change in sentiment. Now, if you recall, I had mentioned last week and on several occasions that the oversold, or what we would call irrational exuberance, when the VIX trades under its Bollinger Band, which we got on March 13th, and then trades back into it, is a warning. Of course, we look for short-term price action to penetrate the 10-day on the underlying index. In this case, the VIX and the S&P are mated. So the fact is that when the S&P started trading a little bit weak in conjunction with the shorter-term indicators that were overbought and generated a sell signal, we were not surprised to see this market sell off a bit. But the other hand, the sentiment here is still very strong and now back sort of into this neutral rating. Now, normally we give it about 10 to 12 days to see if anything more will materialize from the signal. And you can see the VIX now back into what we consider a normal zone. But it's trading pretty low. Let's take a look at the weekly on this. And you can see the weekly on the VIX hitting the lows back from 2010, even back as low as 2008. We're approaching those levels back in 2008 before the financial crisis. So clearly sentiment is very, very strong. And we've got another couple days. If nothing more materializes on the sell-off and we don't breach the 50-day moving average, if there is one, you can say that this signal is now negated and nothing strong, much stronger than a very, very minor sell-off has occurred. So still on the caution. The McClellan oscillator, that intermediate, generated yet another buy signal as we worked off of that sideways action, and still on a short-term sell signal on the looking at on the 10-day advanced decline and up-down volume. Now let's take a look at gold. Let's take a look here. Where do we have a gold chart? All right, GLD. As you know, we had been talking about gold last week and concerned that possibly there was a change in trend, and in fact, things did play out. This market action here was indicating a potential flag. We did get a reaction off the flag, but also held this level here, which was about 158. Now, why was that 158 level critical? Was because on the long-term monthly charts, it's where the big trend came in, and we said that we see a test of that long-term trend, and the market could possibly have a substantial drop, but it's sort of at an inflection point. Now, right here, on Friday's action, we left an island bottom of sorts because the gap down on Thursday, we ended up closing up again at the upper range of the day, but the gap up on Friday persisted, was held, and in fact, you've now left an island bottom here. So if you take a look at that in conjunction with the monthly chart, you can see we tested the long-term trend line on that open lower on Thursday and bounced. So it's going to be interesting to see, because on the daily chart, we're really going to need to get above this 200-day moving average, which is going to act as resistance. So could we see another continuation here of the move up? Very possibly. Again, if the market, this is similar in a way to how I'm looking at the overall market and the indices, because what we have here is what I would consider a compression zone between 158 and that 162 area. If we can power out and really get a couple of closes above the 200, could very possibly mean that the long-term trend has been tested, is still intact. On the other hand, a failure beneath this critical low could mean that gold's in serious trouble. So this merits interest, watching and trading accordingly using the short-term price structure. Right now, this island bottom and in conjunction with that long-term trend suggests we're going to have some continued action to the upside, and let's see what materializes. Now, that's certainly wouldn't be a great sign for the overall markets in general. So we should be watching how gold reacts, as well as the TLTs, right? Long-term bonds, the 20-year bonds. Let's take a look at that, and we'll call it a weekend. All right. So over here, we had mentioned that the sell-off or the rise in interest rates was definitely a potential sea change. And we said that the critical level was, of course, the 50-day moving average and this trend line here. And we wouldn't be surprised because the market on the RSI was oversold. And we were expecting a bounce, which means a little bit reprieve in lower rates. And indeed, we did get it. So now we're trading above the 200-day moving average, moved back with 2 days confirmed above the 200-day into what we call a warning phase, right? Because we're trading under the 50-day moving average, but above the 200. Now, this is a strong warning phase. Why is it strong? Because you can see an accelerating move to the downside. So would I be surprised to see maybe another couple days of strength? Absolutely not. But you're going to run into this wall of resistance right around 116.50. So we can play that accordingly. Another couple days up may give us an opportunity to get short or buy the TBTs. And again, to review the longer-term trend, we know that the longer-term trend is still intact. Here's the monthly trend. We're down here all the way around 96. However, you can see that a double top is also playing out, although this action, obviously, the bounce and the close above the 200-day moving average on the TLTs for a couple days definitely is should put those who think that the overall macro picture has definitively changed on notice. Meanwhile, I would say with the tremendous amount of overhead that we broke through, that should prove to be pretty formidable resistance, but the markets will decide. Anyway, so that's the overall picture for now. Hope you enjoyed this video. If you do, again, don't forget to sign up to get these weekly videos, our market outlook, and or join us on YouTube where the MarketGauge.com videos are being posted. Anyway, have a great weekend and bye for now.